Hello and welcome to Business Incorporated live on Channels Television. Here's what's coming up on the show. Zambia's inflation that cooled to 12.3% year-on-year in September, its lowest in 2 years, driven by slower increases in both food and non-food prices. And South Africa's factory gate inflation picked up in August, with the producer price index rising 2.1% year-on-year, up from 1.5% in July. And Egypt's growth outlook brightens. The EBRD now forecasts a 4.8% GDP expansion in 2025, up from its earlier projection. It's good to have you join us. I'm Ladi Williams. Let's get a quick check on the commodities that we track now, starting with oil prices. We've seen a pullback, but it's mixed sentiment right there. Brent crude this afternoon up about 0.30%, but we see WTI crude, that's down 0.42%, $64.73 a barrel. We've seen a mild pullback with both contracts there, with Brent trying to make a run to about $70 per barrel. We'll see if that hits maybe tomorrow, but we've seen a major resistance at that $70 level for oil, even after touching a 7-week high right now. But we're seeing geopolitics there putting a cap on gains in an oil market. Let's get a check on metals now. We're seeing gold prices climbing today on the back of geopolitical uncertainty and economic risks, that's bolstered the safe haven demand. And investors are waiting U.S. data for signals on Federal Reserve's policy path. And we're seeing spot gold there, that's unchanged, $3,778, still around the all-time highs there. U.S. gold futures, $3,787. And we have a big 2% rises there for spot silver. I guess spot silver on the way to about $50 per ounce at this point. That's on price discovery. But palladium, that's down 2.24% on the flip side at $1,268 per ounce. Let's get a check now what's playing out in southern Africa. We see Zambia's inflation, that eased to 12.3% year-on-year in September 2025, down from 12.6% in August, reaching its lowest level in 2 years. That's according to official data. The slowdown was driven by softer price pressures in both food and non-food categories, with food inflation cooling to 14.6% and non-food inflation falling to 9%. And South Africa's producer inflation, that's at 2.1% year-on-year in August, up from 1.5% in July. According to the Statistics Agency, the producer price index increased by 0.3% month-on-month in August. And we're seeing, definitely once producer prices go up, definitely that translates into the CPI. Then in Egypt, the EBRD, they've lifted the forecast for the Egyptian economy. They're saying it's going to expand by 4.8% in 2025 before moderating to 4.5% in 2026. The European Bank for Reconstruction and Development confirmed that. The lender lifted its 2025 forecast by 0.8 percentage points from May. According to the EBRD, regional economic prospects and the September 2025 report sees an acceleration to 4.2% year-on-year in the first 3 quarters of the fiscal 2024-2025 year, up from 2.4 percentage points in the year earlier, driven by a rebound in manufacturing, solid wholesale, retail, and transport activity. All right, in West Africa, Ghana's electricity tariffs will rise by 1.14% come October the 1st, according to the Regulatory Commission there, as it adjusts for currency depreciation, inflationary pressures, and rising fuel costs. Water rates, however, will remain unchanged under the quarterly review. So that's up for electricity and water prices. That's the tariff on water, that stays stable right there in Ghana. And we see Belarus, they propose to set up an intergovernmental commission in Ghana for trade and economic cooperation during a meeting between the Belarusian Minister of Foreign Affairs and the Ghanaian Minister of Foreign Affairs, Mr. Samuel Abiakwa, in New York. Later learned that according to this new development, during the talks, the minister focused on trade developments, including supplies of Belarusian machinery and equipment to Ghana, the establishment of service and assembly facilities, and the access of Ghanaian goods to the markets of Belarus and the Eurasian Economic Union. So we see both countries there moving along with that. All right, let's go to our next conversation now. Africa faces about $331 billion trade finance gap, a constraint that continues to weigh on economic growth and private sector competitiveness. While some countries are making progress towards narrowing this deficit, questions remain about which sectors and regions are most affected and how financing shortfalls are shaping industries like agriculture, manufacturing, and exports. Joining us for this conversation, however, Oluwatoyin Olaoye is a Chief Risk Officer at Vendor Credit. Great to have you on the show.
Hello, Larry. Great to be on the show.
Yeah, great to have you. So, first off, let's try and understand this financing gap in Africa. We know this is, rates setting season, and we're seeing most of the central bankers, easing interest rates right now. And I'm wondering how this, plays into that whole gap, when it comes to SME financing on the continent.
Okay, thanks for that, Larry. So I think, first of all, we need to just, ensure that there are clarifications about what we mean when we say there's a trade financing gap and what it essentially entails, right? So your trade financing gap refers to the difference between the demand for trade-related financing, so things like letters of credits, trade loans, invoice financing, and the instruments that actually support this, right? So if there's a mismatch between those two things, then we say that there's a trade financing gap. Like you rightly pointed out, the CBN, especially in Nigeria, at their NPR sitting a couple of days ago or yesterday, reduced the NPR to 27% from 27.5 where it was previously, and also reduced the CRR. And so basically what this means is that it allows a bit more flexibility for financial institutions to be able to extend credit to sectors of the economy that actually need it. A good example of this is if you had 100 billion, right, sitting in the CBN, or 100 billion, and the CBN CRR, which was previously 50%, meaning that 50 billion would thereby be sitting in with the CBN and would not be available to be lent, right? But with the reduction to 45%, what you currently have is a situation where you have an additional 5 billion, basically, that banks can lend to sectors in the economy, such as the SME sectors that actually need it, and then ensure that that the economy continues to grow.
So, which sectors or regions in Africa would you say are most affected, and in what ways? We keep talking about boosting agriculture, manufacturing, getting more exports out of Africa.
So you've hit the nail on the head. Agriculture is the #1 sector that is most affected by this gap in financing, right? A lot of the banks, or financial institutions generally provide financing around sectors such as chemicals, consumer goods, so FMCGs basically, because those goods are basically recession-proof and there will always be a demand for it. But we find out that there is a most lack in agriculture, construction and real estate, electricity and power, and then ITC, communication, and then pharma. But the most is notably agriculture.
All right. So, as a chief risk officer, how do you assess, and manage risk associated with providing, supply chain trade credit to SMEs, especially those with, limited credit history or collateral? And I'm sure this recent rate cuts, I guess, is also bringing some kind of excitement to you, I guess.
Yeah, so for us, we take a novel approach to a lot of these issues, right? Whereas financial or traditional institutions rely on things like financial records, CDD on who the promoters of the business are, how many years in operation that the business has been. There's something called open banking infrastructure, which we take advantage of, right? So you get a lot of details from things like bank statements, right? Bank statements will typically show transaction history balances that remain sales records on e-commerce sites. So if the person has been a merchant on any particular site e-commerce that you have in the current marketplace, right? That sales transaction also tells a story about how well they've done, what their order book is like, how many orders they fulfilled. You're looking at things like high sales or repeat orders from verified corporates that give signs of reliable performance. Then customer review ratings, right? You can assign weights to customer review ratings. So on a lot of the sites or a lot of customers, or even on Google, right, you find out that customers have left reviews. And based off of this, you can assign weights that will allow you to ensure that you essentially mitigate your lending risk, right? Also, reputation in the industry. So you have vendors who are supplying multinationals or different corporates, right? You look at the reputational risk of the counterparty if they fail to make a payment as at when due, and that feeds into the risk inherent for the vendor or the supplier that you are providing credit to. So a lot of these things, right? We've created a novel approach whereby we can score credits for we can score and mitigate credit risk for a lot of suppliers who deal in trade finance and in supply chain financing, right? As opposed to the more inflexible and somewhat standardized process that larger financial institutions utilize.
And definitely bring it back to Nigeria now with this recent rate cut. We're now at 27% from 27.5% with a 50 basis point cut there. But I'm wondering, how would the average SME, feel this interest rate cut, in your opinion?
Okay, so basically, like I mentioned, right? So the interest rate cuts allows for it allows you to lend more, right, at a lower interest rate. Like I mentioned, it has created more liquidity for the banks, right? So first of all, looking at it from the CRR reduction, right, lower CRR frees up more cash for commercial banks or financial institutions, right? Since we have, or generally they have to keep less money with the CBN, right? That leads to cheaper cost of funding, right? So there's more liquidity in the system, and more liquidity in the system ensures or pushes interest rates lower, right? Because then everyone is trying to ensure that they can lend to as many people as possible so that they can get benefit of the lower interest rates. So all of that, if you look at it from a supplier or somebody or someone that needs credits point of view, right? It means that there is more money and there are options for them to go around, right? For them to access financing, because then the banks are going to be able to deploy those funds into sectors that actually need it. So the reduction in interest rates in itself is a good one for the economy and for trade financiers as a whole.
Right, and talking about closing gaps at this point, let's imagine we finally close this trade finance gap. What is that going to, translate to in real terms for the African economy?
So in trying to close the trade finance gap, right? You are looking at ways where financiers themselves can get cheaper cost of funding to enable them to do more trade, right? Increase in exports, right? Increase in employment. It allows your SMEs to generally thrive better, right? So there are a lot of benefits to ensure that this gap is closed as much as possible. All we can continue to do at our end is to ensure that the people that actually need this capital get the capital by ensuring that those funds are deployed to the sectors or the SMEs that really need it, and they're not just made into a sound bite that, oh yes, we've given out so much money and then you don't see any effect, right? Because at the end of the day, SMEs are the engine of the economy. So our role is to ensure that the funding gets to sectors and SMEs who actually need the funding, to ensure that that trade gap is closed as much as possible, and so that the economy as a whole continues to grow. If that grows, it has a trickle down effect on where interest rates and where prices of goods and services will be eventually. So all of it in itself, there is a pressing and there's an urgent need to ensure that we close that gap as much as possible.
All right, definitely. We'll keep tracking to see how much progress we make going forward as a continent and as a country. Thank you so much. Oluwatoyin Olaoye is the Chief Risk Officer at Vendor Credit. Thank you for coming on today.
Thank you very much, Ladi.
All right, we'll flip over to another conversation now with the commodities market and, some of these commodities that we like to eat every day. One is chin-chin now. Once a homemade snack has grown into a widely commercialized product across Nigeria, lining the shelves of supermarkets and local shops. Despite falling prices of key inputs like flour, sugar, in recent months, the retail price of chin-chin, that has surged at this point. Let's find out what's driving that. Joining us now is Paulette Paxton Inaros, is analyst with Financial Derivatives Company. Great to have you on the show.
Good afternoon, Ladi. It's a pleasure.
Fantastic. So we're seeing the price of flour, sugar, that's declining according to your data. Why are consumers still paying significantly more for products like chin-chin? What hidden factors are driving this price surge?
Okay, so evidently, some of the input prices of chin-chin, including flour and sugar, have come down recently, but these do not make up the greater costs in the production process of chin-chin. At the industrial level, for large-scale chin-chin producers, they have machinery like dough processors, dough mixers, largely sized baking ovens, and air fryers. So apart from costs of getting their raw materials from suppliers, a lot of the cost comes from energy. It's a very energy and electricity consuming business as of right now. So a lot of the increase in the price of chin-chin comes from that cost incurred from producers from the energy consumed. Then regarding small and medium scale producers, traditionally, they would have to depend on resources like vegetable oil, which already is a very expensive commodity in the market right now because most of these industries import the vegetable oil that they use in the process. So they encounter issues like tariffs and extra import costs from bringing and transporting this vegetable oil from foreign countries, and alongside regulatory issues that can come from the suitable certifications required by different organizations in Nigeria before these products are safe and credible to sell.
All right, yeah, so much to unpack there, and definitely with festivities coming, we hope that these prices don't get another round, of increases. Thank you so much. That was Paulette Paxton, now as an analyst with Financial Derivatives Company. Thank you for coming on today.
Thank you for having me.
All right, let's flip over to the markets now. Let's see what's playing out on the African continent. We did see the NGX there trying to make some kind of recovery at intraday, but it's near flat, 0.05%. But we see a big pullback for the Johannesburg Stock Exchange, 0.40% down. Let's flip over to other markets we track in Africa now. The EGX 30, that's down 0.42%, 35,738 points. And we see the Nairobi Stock Exchange close in the green, 1.61. I'm trying to make a recovery after big pullbacks earlier last week. Let's get a check now on the Gulf region. We see the UAE, it's majorly negative sentiment at intraday, 5,816 points, 0.95% down, 0.32% down for the Abu Dhabi index. Look at Saudi Arabia, that's a Tadawul, and the Qatari index there. We see that's trying to hold up at this point. We did see the Saudi Arabia market there. They tried to close in the green yesterday, but we're seeing a pullback 0.88% and a big 1% drop for the Qatari stock exchange. Let's get a check now on the U.S. Futures to give direction on what to expect in the U.S. markets. 24,000, 25,000 level loss for the NASDAQ futures, 0.39% down, showing us that this might actually close in the red. That's for the U.S. markets at this point. Once the futures kind of give us direction there, 46,381 points for the Dow Jones Industrial Average, 0.12% down. Let's get a quick check on there. The Nikkei holding up 0.27% to close, 45,754 points. Well, it's mostly negative sentiment in Asia. If we look at India, the Nifty 50, that was also under pressure and closed in the red today, 0.65%, and a mild, near flat at this point for the Shanghai Composite at 1 basis point. So let's get a check now on Europe. Now, we see in Europe there's a move by a Chinese company to enter the German auto market, this time with a factory to be built near Berlin. Let's talk to Lars now. But first, let's get a check on the markets in Europe. How are the markets looking in Europe, Lars?
Well, Adi, I got some red numbers here for you. Things, had looked a bit up early in the week, but now we're seeing the DAX down once again and dropping away from its recent highs. And there's mostly two DAX-listed companies that are a bit in the spotlight today. Software giant SAP, after the EU Commission has just announced that they're opening an investigation into unfair market practices in some of its businesses. And then there's also Siemens. Among the many products this giant conglomerate makes is healthcare equipment, and the US under Trump is weighing tariffs on those. So that would likely have negative impact on the company's business, of course. So Siemens as well as SAP, both under pressure, and they're the two stocks that are weighing on the DAX.
All right, let's have a look at some news from the auto sector there. Germany's a big player, but German automakers have seen competition from China for a while now. But there's a new player in the game trying to enter the market. What are you hearing about this?
Indeed, Ladi, we're talking about a company called Dream, and they're a Chinese maker of household electronics, as a matter of fact. So far, their products include robotic vacuum cleaners, robotic lawn mowers, even robotic window washers. But the company is planning to move into the auto sector too, and they're specifically planning to build luxury cars, entirely electric, of course. And so far, they have concepts of these cars, but actually only as concept studies. They have never built a real car. But apparently Dream would like to put up a plant right outside Berlin, indeed very close to the Tesla plant that has already been producing there and has been for a few years now. The local minister president here has already confirmed that there are indeed talks, and from Dream's side, the location would make a lot of sense, especially since Tesla is already there, which means there is a lot of infrastructure, there are suppliers, there are students, possible future workers who have likely looked at a career in the auto sector. So opening a plant near a competitor's plant is certainly an interesting move, but it wasn't easy for Tesla to open that plant a few years ago, and it won't be easy for Dream either. There will be major protests again. There are citizen groups that are fighting such development tooth and nail, and there are even politicians at this point, and they're usually keen on supporting economic development in their region. They are saying that there might just not be room for another gigafactory.
Yeah, quite the competition in the auto industry right now. But are there other possible locations for Dream?
It's interesting, Aladi. It's entirely unclear. It's even entirely unclear why Dream would even try to put up a plant in Germany, to be honest. Even German auto experts are saying that Germany currently is really not a strong contender when it comes to hosting our plant. And Germany has very high energy costs right now. We've talked about that many times, and those high energy costs have been crippling the economy for years now. Wages here are pretty high as well, so that makes for a rather high production cost. Add to that the fact that bureaucracy, of course, is slow and tedious, and getting a plant approved and up and running takes a long time. Now, of course, Ladi, it's understandable that a Chinese company would want to put up a plant in Europe, not least to circumvent the tariffs US President Trump has levied on Chinese products. But the question would be if such a European plant would not make a lot more sense to be built in Poland or the Czech Republic or any other location, especially in southeastern Europe. So as we're hearing about the Brandenburg government talking to the Chinese company, there is also at this point, I would say, a lot of skepticism, and it doesn't really look like we're seeing this happen anytime soon, if at all.
All right, thank you so much, Lars. We'll keep tracking to see how it goes with this auto challenger in Germany. Thank you so much for coming on the show today.
Good talking to you. Thanks, Ladi.
All right, let's get a check on other markets now. The report chaos, so blood red in the crypto market. Was in a bloodbath. That's continuing at this point, with Bitcoin now trading at $111,000 after trying to make that run to $118,000, but we see the bulls got smashed down. Ethereum losing the $4,000 level, 4.52% down. Solana's not left out, back to $200 after trying to get to $250 per coin there. It's red across board. The little pockets of green, those are stable coins showing that traders are trying to run into some safety and stability at this time. And looking at the technical analysis, some analysts say the Bitcoin Bollinger Band, that's at the tightest level right now, showing that there's a lot of volatility right there in the crypto market. We'll see how the Friday trade goes tomorrow, but that's the color for most of the markets that we track right now, the crypto market. We'll give you more updates on what to expect and where to stash cash at this time. Thank you for watching. I'm Laddie Williams. Bye for now.